It's an ordinary day on the trading floor, where fortunes may be gained or lost in the blink of an eye. Meet Sarah, an experienced trader who depends on her knowledge of candlestick patterns to navigate the turbulent market. Sarah's eyes widen when she notices a familiar pattern forming in the chaos. Sarah executes her transaction with steely resolve, secure in her interpretation of the candlestick patterns. Sarah's intuition is validated moments later as the market responds in her favor. Sarah's knowledge of candlestick patterns has transformed a potentially perilous circumstance into a rewarding one. In the world of trading, where uncertainty reigns supreme, traders like Sarah prosper by leveraging the power of candlestick patterns to make sound judgments. For Sarah and other traders, reading the language of candlesticks is more than simply a talent. It is the key to success in the ever-changing market environment. Candlestick patterns are very important in forex trading because they give traders great insights into market moods and anticipated price moves. Here's how candlestick patterns might help you forecast market changes in forex trading. 1. Candlesticks provide a visual representation of market psychology by representing open, high, low, and closing values over a specified time period, which can range from minutes to days. The design and color of the candlesticks offer important information about the conflict between buyers and sellers at the time. For example, a lengthy bullish candle implies significant purchasing pressure, whereas a long bearish candle shows strong selling pressure. 2. Candlestick patterns can assist traders identify market trends and reversals. Patterns such as the engulfing pattern, in which one candle engulfs the preceding one, might indicate possible trend reversals. For example, a bullish engulfing pattern following a downtrend might signal an upward turnaround. 3. Confirmation of support and resistance levels. Candlestick patterns can confirm support and resistance levels on forex charts. Patterns like the hammer, which has a small body and a long, lower shadow, often form near support levels and suggest potential price reversals. 4. Candlestick patterns indicate market reversals and continuations. Reversal patterns such as the evening star, bearish, or morning star, bullish, might signal a shift in market direction. Continuation patterns such as the flag or pennant might indicate a break in the current trend before restarting in the same direction. 5. Risk management. Candlestick patterns assist traders control risk by offering clear entry and exit signals. For example, if a trader notices a bearish engulfing pattern near a crucial resistance level, they may opt to initiate a short position with a stop loss above the pattern's peak in order to minimize possible losses. 6. Confirmation with other technical indicators. Candlestick patterns are often used in conjunction with other technical indicators, such as moving averages or oscillators, to strengthen trading decisions. When multiple indicators align with a candlestick pattern, it increases the probability of a successful trade. In conclusion, candlestick patterns act as a universal language for traders, allowing them to analyze market dynamics and make sound trading decisions in the forex market. By learning these patterns, traders can obtain a competitive advantage and increase their ability to forecast market moves more accurately. Certainly. Let's delve into some of the most common and reliable candlestick patterns used by traders. 1. Doji. A doji forms when the opening and closing prices are virtually the same, resulting in a small or non-existent body with long upper and lower shadows. This pattern indicates indecision in the market, where neither buyers nor sellers have gained control. Traders often interpret a doji appearing after a strong trend as a potential reversal signal, especially if it forms at key support or resistance levels. 2. The hammer candlestick design features a little body toward the top and a lengthy lower shadow, similar to a hammer. This pattern often appears after a decline and indicates a probable bullish reversal. The extended lower shadow suggests that sellers pushed the price down during the session, but buyers were able to drive it back up, indicating buying pressure. 3. Engulfing patterns. Two candlesticks are used, with the second candle engulfing the preceding one. There are two types of engulfment patterns. The bullish engulfing pattern occurs when a bullish candle totally engulfs the prior bearish candle. It indicates a probable turnaround from a downtrend to an uptrend, with strong purchasing demand outweighing selling pressure. Bearish engulfing pattern. A bearish candle completely engulfs the previous bullish candle. It indicates a possible shift from an uptrend to a downtrend, with significant selling pressure outweighing purchasing demand. 4. Evening star. In contrast, the evening star is a bearish reversal pattern that begins with a lengthy bullish candle, followed by a star, and ends with a bearish candle that closes below the first candle's midpoint. It suggests a possible reversal from an uptrend to a downtrend, with the star indicating hesitation and the bearish candle confirming the change. The evening star is a bearish reversal pattern that starts with a lengthy bullish candle, then a star, and finally a bearish candle that closes below the first candle's midpoint. It suggests a possible reversal from an uptrend to a downtrend, with the star indicating hesitation and the bearish candle confirming the change. These candlestick patterns are popular among traders because to their consistency and efficacy in anticipating market reversals or continuations. However, when combining candlestick patterns into trading techniques, traders must also consider volume, trend strength, and general market circumstances. Let's look at several effective and lesser-known candlestick patterns that traders might use in their analysis. 1. The three white soldiers pattern is a bullish reversal indication characterized by three successive, lengthy white or green candles with higher closures. Each candle begins within the preceding candle's body and closes around its peak, indicating ongoing purchasing pressure. The three white soldiers pattern indicates a transition from negative to bullish feeling and frequently precedes major uptrends. 2. The dark cloud cover pattern is a bearish reversal indication that occurs following an upswing. It is made up of two candles. The first is a long white or green candle, and the second opens higher but closes below the first candle's middle. The second candle's body is usually dark or black, indicating probable bearish momentum. The dark cloud cover pattern indicates a likely shift from bullish to negative emotion, and traders may seek confirmation from future market movement. 3. Harami cross, a lesser-known yet effective candlestick pattern that predicts reversals. It is made up of two candles. The first is a huge candle, bullish or bearish, and the second is a small-bodied candle, the cross, that is totally absorbed by the first candle. The Harami cross indicates market hesitation, with the smaller candle signifying a potential halt or reversal in the current trend. Traders sometimes seek confirmation from other signals or indicators before making trading choices based on this pattern. 4. These candlestick patterns provide vital insights into market mood and prospective price movements, making them effective tools for traders looking for high-probability trading opportunities. While certain patterns, such as the three white soldiers, are well known and commonly recognized, others, such as the dark cloud cover and Harami cross, can give distinct indications that less experienced traders may miss. By including these powerful candlestick patterns into their research, traders may improve their ability to predict market reversals and profit on new trends. To have a better understanding, let us explain the important aspects of each candlestick pattern and present real-life trading examples. 3 white soldiers. 3 successive lengthy white or green candles with higher closing show a strong bullish reversal signal. Example: suppose XYZ stock has been in a downturn for weeks. Suddenly, 3 straight days have seen powerful bullish candles, each ending higher than the preceding one. This pattern indicates a probable shift from negative to bullish mood, providing a chance for traders to start long positions. 1. Dark cloud cover. Key points: A lengthy white or green candle is followed by a second candle that begins higher but closes below the previous candle's midpoint, signaling a possible bearish reversal. Example: ABC stock has been on a steady upward trend for several months. A dark cloud cover pattern emerges when the first day features a powerful bullish candle, followed by the second day, which opens higher but closes below the first candle's midpoint. This pattern signals a likely reversal in mood, indicating that traders should consider short positions or tighten stops on long bets. 2. Harami cross. Important points. A giant candle is followed by a small-bodied candle, the cross, which is totally absorbed by the first candle's body, signifying hesitation and probable reversal. A real-life example. DEF stock has been continuously rising. Suddenly, a giant bullish candle is followed by a small-bodied candle, cross, which is totally consumed by the first candle. This Harami cross pattern indicates a possible halt or reversal in the uptrend, advising traders to take care and seek more confirmation before taking fresh positions. These real-life examples show how traders may detect and analyze candlestick patterns in real-world market conditions to make more educated trading decisions. Understanding the essential elements of each pattern and tracking their occurrences on price charts may help traders better forecast market reversals and profit on developing trends. Absolutely. Identifying and interpreting candlestick patterns is an essential ability for any trader attempting to navigate the complexity of the financial markets. If you want to improve your trading skills and obtain a competitive advantage, I recommend you practice detecting these candlestick patterns on trading charts. You'll get a better grasp of market dynamics and make better decisions if you practice recognizing patterns like the 3 white soldiers, dark cloud cover, and Harami cross. Begin by reviewing past pricing data and noting how these patterns appear in various market scenarios. Don't stop there. Stay tuned for our forthcoming videos where we'll go over more sophisticated trading tactics and approaches. From trend analysis to risk management tactics, we'll cover a wide range of subjects to help you advance your trading skills. Remember, persistent practice and ongoing learning are essential for being a great trader. So roll up your sleeves, dig into the charts, and join us on this exciting voyage of discovery and growth in the world of trading. Stay tuned for our expected videos, and let's take this trip together to trading expertise. Trading expertise.